There's a new deduction sitting on this year's tax return worth up to $12,000 for a married couple, and the IRS is not going to call you to tell you it exists. Heads up, this is general information, not personal tax advice, and it applies a little differently depending on your income and filing status. Now let's get into number one, because this one alone could change what you owe next April. Here's the situation. You turned 65, maybe a few years ago, maybe this year. You filed your return the same way you always have, because nothing about the process ever changes, right? Wrong. Congress passed a massive tax law in the middle of 2025, and buried inside it were several brand new tax breaks built specifically for people your age. Not for young families, not for business owners, for you. And the IRS has confirmed that most of these don't require a single form beyond what you already file, which is exactly why so many retirees are going to miss every one of them. They'll take the same standard deduction they took last year, hand their documents to the same preparer, and never once hear the words "enhanced deduction for seniors" out loud. If your household brings in a modest fixed income from Social Security and a small pension, this can mean several $100s back in your pocket. If you're a comfortable retiree with a paid-off house and some savings, this can mean thousands. And if you're the kind of person who's been quietly giving to your church or a charity every year without ever seeing a tax benefit for it, there's a change buried in here for you too. So here's what's ahead. 8 things the tax code lets you claim, use, or protect once you cross into your 60s and 70s, in plain English, with real numbers attached to every one of them, plus what most retirees get wrong on each one. Every single thing in this video comes straight from IRS guidance and the text of the law itself, nothing from a rumor or a forwarded email. The extra deductions for seniors come from what's officially called the One Big Beautiful Bill, signed into law in the summer of 2025, and the IRS has already published updated worksheets, forms, and filing season guidance, walking through exactly how each one works. The rules around Social Security, Medicare premiums, and required withdrawals come from existing law that the Social Security Administration and the IRS publish every single year. None of this is guesswork, and none of it requires an accountant to unlock. It just requires knowing it exists. Number 1. The regular extra standard deduction for being 65 or older. This one has existed for decades, so if you filed taxes since turning 65, you may already be getting a piece of it. But here's where people get it wrong. They don't realize it went up again this year, and they don't realize both spouses can claim it separately if both are 65 or older. For this tax year, a single filer or head of household who is 65 or older gets an extra $2,050 added directly onto the regular standard deduction. No paperwork required beyond checking a box on the return. If you're married filing jointly, it's $1,650 per qualifying spouse. So if you're both 65 or older, that's an extra $3,300 stacked on top of your normal deduction before you've done anything else. Most people stop here and assume that's the whole senior tax break. Don't, because number 2 is where the real money shows up. Number 2, and this is the one almost nobody watching this has heard about yet, because it's brand new. A separate temporary bonus deduction of up to $6,000 per person on top of everything in number 1. This is not the old age-based deduction. It's an entirely new one, created by that 2025 tax law, available for tax years 2025 through 2028 only. If you're 65 or older by the end of the year, you can claim an additional $6,000 deduction. If you're married and both spouses qualify, that's $12,000 combined. And here's the part that surprises people. It doesn't matter whether you take the standard deduction or itemize. You can claim this one either way. Now here's where it gets important. This deduction starts phasing out once your modified adjusted gross income crosses $75,000 for a single filer or $150,000 for a married couple filing jointly, shrinking by 6% for every dollar above that line. So a retired couple living on Social Security, a pension, and modest IRA withdrawals totaling under $150,000 gets the entire $12,000. A wealthier retired couple pulling in $200,000 a year will see it shrink and eventually disappear. Here's what most retirees get wrong on this one. They assume because it's called a bonus, it's automatic. It is not automatic. For the 2025 return, the IRS created a new form, Schedule 1A, specifically to calculate and claim it. If your preparer doesn't walk you through that schedule, or if you're filing your own return through basic software that doesn't prompt you for it, this $6,000 per person can slip through completely unclaimed. Number 3, and this is less a form and more something you need to understand so you don't accidentally trigger it, the Social Security stealth tax. Here's what almost nobody realizes. The income thresholds that determine whether your Social Security benefit gets taxed have not moved since 1984, not adjusted for inflation, not touched. If your combined income, meaning your adjusted gross income plus half your Social Security benefit plus any tax-exempt interest, crosses $25,000 as a single filer or $32,000 married filing jointly, up to 50% of your Social Security becomes taxable. Cross $34,000 single or $44,000 married, and up to 85% becomes taxable. In 1984, almost no retiree crossed those lines. Today, a retired teacher with a modest pension and a Social Security check crosses that first threshold almost automatically. Here's where it gets important. This isn't a form you file to get money back. It's a trap you can accidentally walk into by pulling extra money out of an IRA at the wrong time, in the wrong year, pushing your combined income over that line, and making a slice of your Social Security taxable that didn't have to be. Most retirees get this wrong by taking a big lump sum withdrawal in December to cover a home repair or a gift to a grandchild, not realizing it can tip thousands of dollars of Social Security into taxable territory for that 1 year. Number 4 connects directly to number 3, and it's one of the cleanest tools in the entire tax code for anyone 70 and a half or older. The Qualified Charitable Distribution, or QCD. Here's the rule. If you're 70 and a half or older and you have a traditional IRA, you can transfer money directly from that IRA straight to a qualified charity, and that money is completely excluded from your taxable income. Not deducted, excluded. It never shows up on your return as income at all. For this tax year, you can send up to $111,000 this way. And if you're 73 or older and required to take a minimum withdrawal from that IRA anyway, a QCD counts towards satisfying that requirement. Here's a real example. Say your required withdrawal for the year is $20,000, and you already give $5,000 a year to your church or a local charity out of pocket. If you instead direct that $5,000 straight from your IRA to the charity as a QCD, your taxable withdrawal drops to $15,000 instead of $20,000, and none of that $5,000 ever touches your tax return, which can also help keep you under the Social Security thresholds we just talked about in number 3. Now here's the part they never tell you. The transfer has to go directly from your IRA custodian to the charity. If the check gets made out to you first and you deposit it, then write your own check to the charity, it does not count as a QCD. No exceptions. Number 5 is smaller, but it's brand new for this year, and it applies even if you take the standard deduction, which almost nothing else on this list does. Starting this tax year, if you don't itemize, you can still deduct up to $1,000 in cash donations to charity as a single filer, or $2,000 if you're married filing jointly. This is separate from everything else. You don't need $70,000 of itemized deductions to unlock it, you just claim it directly. Most people who've given up on tracking charitable receipts because they take the standard deduction anyway have simply stopped keeping records. Don't. Even a modest amount you give to your church, a food bank, or a local shelter now has a direct path onto your return. Number 6 is one of the most overlooked credits in the entire tax code because the name makes it sound like it doesn't apply to you. The credit for the elderly or the disabled, found on Schedule R. Most people hear the elderly or disabled and assume it's for a nursing home resident on a fixed disability income, not someone living comfortably in their own home. Here's the honest truth. It's a narrow credit aimed at retirees 65 or older with fairly limited income, generally under about $25,000 for a single filer, or somewhere around $32,000 combined for a married couple, depending on how much non-taxable Social Security you receive. Where it applies, it can be worth up to a little over $1,000, applied directly against tax owed, not just against income. Most retirees in this income range have never heard of Schedule R because their preparer software doesn't surface it unless specifically checked. If your income is on the lower end and you've never asked your preparer about this one by name, that's exactly the conversation to have this year. Number 7 is the one that quietly costs retirees the most money without them ever realizing it: the medical expense deduction threshold, and specifically the mistake of not bunching expenses. You can deduct unreimbursed medical expenses, but only the portion that exceeds 7.5% of your adjusted gross income, and only if you itemize instead of taking the standard deduction. Here's where it gets important for anyone facing a big medical year: a hip replacement, a hearing aid, months of physical therapy, or a parent's memory care costs. If your adjusted gross income is $60,000, the first $4,500 of medical expenses in that year don't count toward the deduction at all, only the amount above that. Most retirees spread big medical expenses across 2 calendar years without thinking about it: a procedure in December and the follow-up bills in January, which means neither year crosses that 7.5% line, and the entire deduction disappears in both years. The fix is simple. If you know a major medical expense is coming and you have any control over timing, non-emergency dental work, an elective procedure, a Medicare Part B premium payment, pull as much of it as possible into the same calendar year so you actually clear that threshold once instead of almost clearing it twice. Number 8, and this is the one I want you to remember most, because unlike everything else on this list, it isn't about a deduction at all. It's about fixing a mistake the government already made against you: appealing an unfairly high Medicare premium through Form SSA 44. Here's what almost nobody understands about how Medicare premiums work. Your Part B and Part D premiums this year are based on your tax return from 2 years ago, not your income right now. That means if you sold a home, cashed out a large retirement account, or had any kind of unusually high income 2 years ago, Medicare may be charging you an income-related monthly adjustment, sometimes called IRMAA, based on income you no longer have. Here's the part that matters. If you've had what the Social Security Administration calls a life-changing event since that tax return was filed — retirement, a reduction in work hours, the death of a spouse, divorce, or the loss of pension income — you can file Form SSA 44 and ask Social Security to recalculate your premium based on your current lower income instead of that old tax return. Most retirees pay the elevated premium every single month for years without ever knowing this form exists, because nobody at Medicare or Social Security calls to suggest it. They simply keep charging the higher rate until you ask them not to. So here's the one thing to actually do this week. Pull out last year's tax return and specifically look for whether your preparer included Schedule 1A for the new $6,000 senior bonus deduction and Schedule R for the elderly and disabled credit. If either one is blank and you think you might qualify, that's the conversation to have before you file again, or the amendment to look into if you already filed and missed it. That single 15-minute check is worth more than anything else in this video. If this saved you money you didn't know was sitting on the table, subscribe, because every week on this channel I take one more piece of the tax code written to be skimmed past and turn it into something you can actually use before the deadline that matters to you arrives. Next week, we're breaking down exactly how required minimum distributions changed under the newest rules, and the one mistake that pushes retirees into a higher bracket without them ever realizing it happened.